We have a condition where consumer confidence is weak, business confidence as reflected by their inability to spend or unwillingness to spend. Business confidence is weak. But one area where there's confidence has been strong is in the government spending. So the government spending, the yellow line, has been rising. And part of the reason is the stimulus. And I think only in hindsight people will judge how effective the stimulus plan was, because there's various ways to measure it. It's more difficult to dissect the data today. But also because we encounter a recession, government receipt fell. People are not working, they're not paying taxes. So a combination of both has led to this monstrously high budget deficit. And as a result, deficit commission was set up, and deficit commission is to formally bring a report out on December 1st to how to reduce budget deficit, which Congress may adopt, they may not adopt, they may decide to adopt small part, but some of the information was leaked out, or it was purposely leaked out, to say that perhaps mortgage interest deduction needs to be on the table to close the gap between this outlay and the receipt, which I will come back to discuss on that part as well. Economy, technically we are out of the recession because GDP is a measurement of production. For the past 5 quarters, it has been rising. Not robustly, but it's still rising. So technically we are out of the recession. But unemployment rate, high unemployment rate would say that to the Main Street that we are not out of the recession. This is the job picture. At least it turned the corner. This is as of September. October data shows further strengthening. So through October is a 1 million job creation, but that's after 8 million job losses. But at least it turned the corner. So at least the things are no longer bleeding further at this time. And this is the total job in the US. So one sees that today's job level matches up with the year 2000. 10 years ago versus today, we have 30 million additional people. So we cannot have the same number of jobs as 10 years ago, but that's what we have, even though we have 30 million additional people living in the country. So to get back to normal, in terms of the job market, not the housing market, in terms of the job market, it really requires some robust job creation. On the bottom part, 300, 400,000 net job creation per month will be needed to get back to normal in terms of 2 or 3 years from now. But if there's only 100,000 job creation per month, which is we are doing right now, this is the current average, then we are just treading waters. Unemployment rate is not moving. Because you have college graduates, high school graduates coming into the market looking for a job, and you cannot provide job, unemployment rate will not change, even though there is some job creation. So it really requires much faster job growth, but for that to happen, business spending needs to kick higher. And there's various arguments as to why business spending is lackluster. Some people say Washington is the problem, creating uncertainty. Other people say businesses are not spending because they know consumer confidence is weak. And since consumers and businesses are not spending, only Washington can spend to help recover the economy. So in one sense, people are saying Washington is the problem. In other sense, other people are saying that Washington could be the part of the solution. A lot of disagreement there. This is a 10-year chart on the local market job picture. So now I forget which one is Boulder and Fort Collins. Actually, the red is Fort Collins because Fort Collins is doing a little better in terms of job creation. So there's a higher number of jobs today than 10 years ago in Fort Collins, but in Boulder, about the same. Roughly no change 10 years ago. Denver situation, very similar, but I also wanted to give you share with you what's happening in Michigan, just to show that, relatively speaking, be fortunate. These are 10 straight years of economic recession in Michigan. The only other area where there is an opposite trend is in Washington, D.C. So that's about the only market where, but rest of the country is undergoing pain. But long-term trend in Colorado is interesting, because short-term trend, which the chart that I showed you was from 2000 to 2010. So if you look at the sort of second half of the graph, it shows no job growth in the second half. But the prior, 1980 to 2000, that's a fast growth. In fact, a job went from roughly 1 million to 2 million, doubling in the total jobs in the state of Colorado over a 20-year time span. If that trend had continued, you would have 3 million jobs in the state of Colorado rather than current 2 million. So that trend, which has been rising, in a sense, got disrupted because of the economy, the housing market, general migration pattern had greatly slowed down. But as the economy steadily improves, and I think it will improve, the question is whether it will be a strong growth or modest growth. Right now, my baseline is modest growth, but let's say if it's a strong growth, somehow business spending really kicks in, then you would have normal migration pattern. And what is that normal migration pattern? Normal migration patterns that people in New York, Massachusetts, and New Jersey are moving out of the state. People in Michigan, Ohio, Illinois, they're moving out of the state. Where are they going? Well, they go to Rocky Mountain states. Utah and Colorado historically has been good draw for people who are moving out from other states. The only western state where there's a net negative migration, meaning people moving out, is California. And where do Californians go? Well, they come to Colorado, and when Californians sell their home, they're selling those expensive homes in California. So when they come to Colorado, they say, wow, this is an affordable market, a great deal. And as a business person, you say, welcome, Californians. Just don't bring your personality with you. Just bring, this is not a joke to Fred, because he said he went to University of Colorado, so he's fine. The existing home sales, again, the tax credit caused some volatility. Tax credit really brought the buyers back into the market. Housing market is not like other market, like market for apples or market for furniture, where you drive the prices down and there will be more buyers. Housing is something fundamentally different. Prices decline, and you can actually have a situation where people actually hold back. But in some cases, people enter, but not always. And the reason why people hold back when prices fall down, even if they have the financial capacity, is to say, why should I buy now when 1 year from now you will be 10% lower or 20% lower? So just because prices decline do not mean the buyers will return. Sometimes it happens, sometimes it doesn't. And in my assessment, I thought the prices were overcorrecting a bit. So only way to counter some of the consumer confidence factor, which NAR really pushed in terms of advocacy, was let's counter that pessimism. Let's put $8,000 on the table and see how the consumers respond. And consumers responded. They came into the market. I would say that most of the people who came into, who bought a home would have bought the home anyway, but that stimulus impact I still estimate to be about 1 million additional home buyers who entered the market who would have set out, and that is that extra hump that you see coming into the market, and that, as a result, that helps stabilize the prices. And with the stable prices over the past 18 months, hopefully many of the consumers who have been sitting on the sidelines say, well, the bottom has already occurred. And if that's the case, then we can go back to the normalcy, because that's what we want. We don't want the hyper speculation. We don't want the bubble. We just want to return to the normalcy. But after tax credit disappeared, big plunge. But that's rational. Consumers would sign the contract in April, and you should ask the question, who the heck would sign the contract in May? Because when May sales plunge, the national media made it out to be skies falling scenario. And that's not the case. Consumers are rational. As the question should have been, why are those few consumers signing the contract in May when they could have done it in April? But now we are well past those months. We are entering the winter months, and I think the winter months are about the time where the tax credit impact has been pretty much done over with in terms of swings of high sales and low sales. So it's enough time where we can see whether the market is now returning back to normal. And winter time generally is a low sales activity. However, if this winter matches up with other normal winter sales month, meaning 2001, 2002, I think that's a very good indicator that spring buying season come. Even without the homebuyer tax credit, we are going to encounter a normal spring buying season. So that is what I will be looking for, whether the sales activity this winter matches up with other comparable winter months. Because it is showing some slow recovery from very, very low levels, and let's see whether it can return to more normal. This is the Colorado, the tax credit impact, changes in sales from 1 year ago. So tax credit really had a big impact. Tax credit disappear once you have a pause period. The long-term sales trend is that today's sales activity are matching up with about 1997 levels. So it is much lower than historic norm. So there could be this pent-up demand. Again, that there's 30 million additional people in the country, but why is the sales level only matching up with that time period? And furthermore, the migration trend, once the economy begins to improve, I think you will begin to see normal migration trend, which means that Colorado will begin to see more outsiders moving into the states. The local market price trend in the Denver area, I think we have another person, local expert, discussing about very detailed local price data later in the afternoon.